So, do you want to know how to potentially double your money in 10 years with a single ETF? Today we are diving deep into the swap US dividend equity ETF, the SCHD. This is the dividend powerhouse that's caught the attention of income hungry investors everywhere. In the next few minutes, you will learn why this ETF might be the secret weapon your portfolio has been missing. Or is it just another overhyped investment? Stick around because your financial future might thank you for it. First off, what exactly is SCHD? SCHD is an ETF that focuses on high quality dividend paying US stocks. But here's the kicker, it's not just about high yields. SCHD looks for companies with a history of consistently paying and growing their dividends. Now, let's break down why SCHD has become a favorite among dividend investors. First off, low cost. With an expense ratio of just 0.06%, SCHD is one of the cheapest dividend ETFs out there. And that means more of your money stays in your pocket invested and working for you. Number 2, quality focus. SCHD doesn't just chase high yields. It screens for companies with strong fundamentals, including 10-year of dividend payments and other financial health metrics. This approach helps avoid dividend traps. Then number 3, diversification. The fund typically holds about 100 stocks across various sectors, and this spreads your risk and gives you exposure to different parts of the economy. Number 4, the SCHD dividend history. SCHD is known for its strong performance and attractive dividend yield. Here's an overview of the dividend history and growth over the past 10 years. SCHD has demonstrated a consistent and robust dividend growth trajectory, which is appealing to income-focused investors. Over the last decade, SCHD's dividends have generally risen each year, reflecting the fund's focus on high-quality dividend-paying companies. As the fund matured, the dividend payments began to increase more significantly. This can help combat inflation and boost your income stream. Now, let's peek under the hood. What kinds of companies does SCHD hold? The fund tends to be overweight in sectors like financials, healthcare, and consumer staples. Number 5, the top 10 holdings usually make up about 40% of the fund's total assets. This concentration gives the biggest companies a significant impact on the fund's performance. Now, let's dive into the juicy part. Performance. The SCHD isn't just about dividends, it's a total return powerhouse. So picture this, over the last decade, SCHD has been quietly crushing it with an average annual return of 10.81%. And that's not just good, it's life-changing good. So let me put that into perspective for you. If you had the foresight to invest $10,000 in the SCHD 10 years ago, you would be sitting on a tidy sum of $26,000 today. That's more than doubling your money. But here's where it gets really interesting. In just a moment, I'm going to review how SCHD stacks up against the mighty S&P 500. And trust me, you will want to stick around for this. It might just change the way you think about dividend investing. So it's not just a dividend fund, it's a collection of high quality dividend paying companies across various sectors of the US economy. So this sounds really good, right? But remember, no investment is perfect. Here are a few potential drawbacks to consider. First one is the US focus. The SCHD only invests in US companies. So if you want more international exposure, you will need to look elsewhere. Number 2, the large cap bias. The fund tends to focus on larger companies which might not grow as quickly as smaller ones. Number 3, sector concentration. Depending on the market environment, the SCHD sector concentrations could lead to underperformance in certain years. And now, for the moment you have been waiting for. How does SCHD stack up against the heavyweight champion of the investing world, the S&P 500? Over the last decade, the SCHD delivered a solid 10.81 annual return. Pretty impressive, right? But hold on, because the S&P 500 index clocked in at a 12.72% over the same period. Now you might be thinking, but wait a minute, doesn't that mean that SCHD underperformed? And you would be right, but don't write off SCHD just yet. And here's why. Remember, SCHD is delivering these returns while focusing on dividend paying stocks, which often prioritize stability over aggressive growth. SCHD typically offers a higher dividend yield than the S&P 500, which can be crucial for income-focused investors. And the last one, in certain market conditions, particularly during downturns, SCHD's quality focus might provide more stability than a broader market. So while SCHD didn't beat the S&P 500 in pure returns, it's not trying to. It's aiming to provide a balance of growth and income that many investors find attractive. But hold on to your portfolio, because we are about to take this investment journey to the next level. If you thought SCHD performance was impressive, wait until you see what I've uncovered. In my next video, I'm pulling back the curtain on two other ETFs that might just blow your mind. And one of these ETFs, let's just say it's not just beating the market, it's just leaving the others in the dust. Curious? You should be. This isn't just about numbers, it's about potentially transforming your investment strategy.